Hey everyone, it's Izzy. Welcome back. We are answering more questions from the internet. Today we only have two, but they are big ones. First, we're going to talk about mortgage insurance, or PMI. And then we're also going to talk about whether or not it is possible to buy a home with no money down. In the past few videos, we've had Jennifer Quattrone from Howard Hanna Mortgage, and she is back. We're jumping back into the same Zoom interview I did with her a couple weeks ago, so if you're wondering why we're wearing the same clothes, that is why. Don't forget to like and subscribe if you find any of this information helpful. And without further ado, let's get to the questions from the internet. Seems everyone wants to avoid PMI, so I'm hoping we'll get into a little bit on your opinion on whether or not PMI is really a bad thing. But the first question is, I am weighing the pros and cons of putting 20% down versus putting less. Simple internet searches show PMI as a 0.5 to 1% monthly cost. What specifically calculates this percentage? Credit? The mortgage company?
On a conventional loan, the mortgage insurance is based off your credit score, down payment. So it varies. So if you have really good credit and 10% down, your mortgage insurance is going to be very low. Here's my theory on this. Buy when you want to buy. And don't base it off of this mortgage insurance. A couple things happen. Mortgage insurance makes your loan more attractive to lenders, because somebody else has skin in the game. Like if you do happen to foreclose, then that mortgage insurance helps the investor. So mortgage insurance is not a bad word in the mortgage industry. And it can be very low, and it goes away once you get to that 20% equity.
Okay, just want to cut in here to remind you that we're talking about conventional mortgages. In the case of FHA loans, the mortgage insurance works a little bit differently, and it is not eliminated once you reach 20% equity. I'll link below to the video that we did about mortgage basics, where we talk more in depth about the difference between FHA and conventional. Anyway, back to it.
So if you're waiting till you have that, and we all know in life things come up, so you're saving and then you have to buy a new car because your car is no longer running, then you're starting all over again, possibly, because you're using some of that money to start over again. It can end up to be like a real treadmill. The other thing is right now, rates are so low and so good. Why would you want to wait just to get rid of that mortgage insurance, which might be $30 a month, and then pay a higher interest rate later on? So my theory on that always is look at what the mortgage insurance is. There are ways to remove it. You can talk to a loan officer about that and see what works the best for you. But in most cases, I say put little money down, pay the mortgage insurance, and get into the home that you love.
So in the case that someone does have 20%, or hopefully more because you don't want to be spending all your savings on your down payment, do you recommend that they then do put down that full 20%?
Sure. I mean, if they already have their savings, they can put the 20% down. But I spoke to a guy, an older guy today, and I just assumed he had the money. I assumed he was to put 20% down. So that's what I did. And then we were talking, he's like, I want to put less down. Is that going to be a problem? I said, no, you're going to pay mortgage insurance. And he was fine with that because, he had good credit and the mortgage insurance was going to be very low, and he'd rather use that money to make repairs to the house, which made a lot more sense, really. So that's how we structured it. But it's going to be different for each person. It's going to be a preference. But mortgage insurance is not a terrible word, and nobody should be afraid of it.
Okay, that kind of rolls into my next question. So if you're an HGTV fan and you're watching Fixer Upper or a show like that where they talk about building equity through home improvements, either by putting in a new kitchen or totally rehabbing a home, is that a way that you can eliminate PMI for someone like the person you just mentioned who's using some of their cash to improve the home?
You used to be able to, but not anymore. So it goes off of the purchase price always, unless you refinance. So sometimes what we do is you'll have a buyer and they'll do 3.5% down, and they'll move into the house with little money. And then they'll put that new kitchen, new bath in, and they'll call you and they'll be like, Izzy, my house worth a lot more money now. and we'll talk to them, and that'll make sense for them to refinance at that point into a conventional loan, because then we will be able to use all those repairs as the new value and remove that mortgage insurance quicker.
Okay, so touching back on something you said a minute ago, which was buy when you want to buy, here's a question from a move-up buyer. I own a house already and need to upsize. I found a house I want that is in my price range, but I haven't been saving for a house currently because since I bought my house 6 years ago, I have been dumping cash into my mortgage to pay it off early. Is there any way for me to buy this house with little to no money down, at least until I could sell mine?
We have a couple different things. We have the buy before you sell, which we could maybe pull some equity out of that house and use as a down payment. And yes, we have different programs that they could possibly qualify for that would get them in there with little to no money, and they could go on and sell later. The buy before you sell is the best program for that, though. If we can pull the equity out of that house, we can do that.
And that can be used for down payment and
closing costs, whatever you need to buy into that house.
Okay. And what about for someone who doesn't own a home? Is there any way to buy with no money down?
Well, so I don't like to say no money down. There is a USDA loan, which is zero down, and a VA loan, of course, is zero down. But most people, I do have one program that is a closing cost assistance, so we can get seller assistance closing cost. You need a minimum of $1,000 to get into that house. But typically, in most cases, it's going to be, $5,000, I think, is reasonable.
So not entirely impossible.
Yeah, like I've done some really fascinating things, where I've given the vet back, exactly what he brought to the table, and it makes you feel good. And there are isolated cases that it works, and there are some creative financing that we can do. But I don't like to promise that to people, because on the average, you're going to need some money.
Okay, so that wraps up this one. I just want to leave you with a final thought, and that is, what is worse, paying PMI or paying rent? There are still more questions about real estate on the internet, which means more videos to come soon. Of course, you can always submit your own questions if you'd like. Feel free to leave them in the comments below, or I have my contact information in the description. But for now, I'm Izzy. Thanks for watching and have a great day.